Hey everyone, welcome back to Corporate Dakota, the place where we try to make sense of companies that would rather speak in legalese than plain English, so buckle up. Because today we are diving deep into Ton Strategy Company's proxy statement, which is essentially a yearly report card asking shareholders to vote on important company matters, and boy oh boy, do they have some interesting things to talk about. Imagine this, you're invited to a yearly meeting as a shareholder. You get to help decide who runs the company, if the executives are getting paid too much, and if the company is even being audited properly. That is exactly what this document is all about, but with a Ton Strategy Company twist. Ton Strategy Company is putting out this proxy statement to formally invite its shareholders to its 2025 virtual annual meeting. Think of it as a big online gathering where important decisions get made. They're going to talk about electing new directors, an advisory vote on how much to pay their top executives, and whether to approve their accounting firm. Basically, it is shareholder democracy in action, but in a very official, very corporate way. This meeting is scheduled for the 24th of October 2025, and it is happening entirely online. This is a big shift from the old days of in-person meetings. Shareholders will be able to attend and vote from anywhere using a special control number. It is convenient, sure, but it also means a lot of the old charm of a shareholder meeting might be lost. First up, they need to elect 5 directors. These are the folks in charge of guiding the company. It sounds straightforward, but directors are the ones who make the big decisions. You'll see names like Manuel Stotz, Nicholas Carey, Rory J. Kataya, Tucker Highfield, and Evan Sorn. They are all up for re-election or serving longer terms. The board is recommending you vote for them, which is pretty standard. Now, let's look at who is actually on the board. We have Manuel Stotz as executive chairman, Nicholas Carey, Rory J. Kutaya, Tucker Highfield, and Evan Sorn. Some of these folks are new to the board, appointed in August 2025, and some have been around longer, like Rory J. Katia, who's been a director since 2014. It is interesting to see the mix of experience here. You have folks with backgrounds in finance, technology, and even law. Nicholas Carey, for example, is a co-founder of blockchain.com. Tucker Highfield comes from Genesis Digital Assets, a Bitcoin mining company. Evan Sorn has CEO experience in SaaS and recruiting platforms. And Manuel Stotz is the founder and CEO of Kingsway Capital Partners, an investment fund. This diverse background suggests they're trying to build a board that understands the cutting edge of finance and technology, especially with the digital asset space. This is where things often get spicy. Shareholders get to vote on whether they approve the compensation of the named executive officers. This is a non-binding vote, meaning the board doesn't have to follow it, but it is a strong signal of shareholder sentiment. They want to make sure the top brass is being paid fairly for their work, and they get a say. This one's a bit meta. Shareholders are being asked how often they want to vote on executive compensation. Annually, every 2 years, or every 3 years. The board is recommending they vote for 1 year, meaning they want to have this say on pay vote every single year. This shows a desire for ongoing shareholder input on how executives are compensated. This is about trust. Shareholders are asked to ratify the choice of Grassi and Company CPAs, PC as their independent auditor for the year ending the 31st of December 2025. This firm is responsible for making sure Ton Strategy Company's financial statements are accurate and reliable. It is crucial for transparency and investor confidence. They previously dismissed Weinberg and Company, Pennsylvania, which is a common occurrence in business. Ton Strategy Company is emphasizing that this meeting is virtual. Only you can physically attend. You need to go to a specific website, www.virtualshareholdermeeting.com/tonks2025am, and use your 16-digit control number. If you are a stockholder whose shares are held by a broker, you need to follow their specific instructions to vote. This is important because for non-routine matters, like electing directors or approving executive pay, your broker can vote your shares unless you tell them how. Let's break down the voting choices for each proposal. For electing directors, you can vote for all, withhold all, or for all except. For approving executive compensation, it is for against or abstain. For the frequency of future votes, you pick 1 year, 2 years, or 3 years. And for ratifying the accounting firm, it is for, against, or abstain. Most of these are straightforward, but the for all except option for directors gives shareholders a bit more nuanced control. Now, let's get to the juicy part, executive compensation. We're looking at the summary compensation table for 2024, Rory J. Katia, the former chairperson and CEO, had a total compensation of $1,730,000 with a salary of $490,000 and a significant portion coming from stock awards. Bill J. Rivard, the former interim CFO, earned $479,000. For 2023, Katiai's total was $976,000 and Rivard, S was $306,000. The stock awards are a big part of their pay, which is designed to align their interests with shareholders. What is really interesting is how compensation actually paid differs from the reported numbers. For Katia, the compensation actually paid in 2024 was $1,502,000, and for 2023 it was $340,000. This difference often comes from how equity awards are valued over time. This section really highlights the disconnect between pay and performance. In 2024, Ton strategy company S total shareholder return decreased by 98%. That is a massive drop, yet compensation actually paid to their CEO went from $340,000 in 2023 to $1,502,000 in 2024. The average compensation for non-CEO named executive officers also increased from $312,000 to $386,000. This is the kind of thing that makes shareholders scratch their heads. A nearly 100% drop in shareholder value while executive pay skyrockets suggests a potential misalignment between management, S rewards, and the company, S actual performance for its owners. The same trend is seen in 2023, where shareholder return dropped 100% while compensation actually paid to the CEO decreased. But still, the overall picture is concerning. Looking at who owns the company is key. Manuel Stotz directly owns a significant chunk, holding 12,021,720 shares, which is 20.0% of the company. This is very concentrated ownership, with Kingsway Capital Limited Partners also holding the same amount as Manuel Stotz as the CEO of Kingsway Capital. This indicates a strong influence from Stotz and his investment fund. They also have Vi Capital Management Company Limited and Tom's Capital Investment Management LP as significant shareholders. This level of insider and major investor ownership often means these individuals and entities have a substantial say in company decisions. Here we see some interesting related party transactions. Rory J. Katia, the former CEO and current board member, had outstanding notes payable to him. On the 1st of December 2015, a convertible note was issued to him for $1,249,000. By the 31st of December 2024, the outstanding balance was $0. Similarly, another convertible note from the 4th of April 2016 in the amount of $343,000 also had its balance paid off by September 2023. These notes were used to consolidate loans and advances made by Mr. Katia to the company. While these debts have been settled, it highlights past financial dealings between the company and its key figures. They also had a Series B preferred stock with Mr. Katia, which was redeemed for $5,000 on the 20th of April 2023. Also importantly, on the 7th of August 2025, Ton Strategy Company conducted a private placement, raising approximately $558 million. This involves selling shares and pre-funded warrants to investors like Kingsway Capital, Vi Capital, and Tom's Capital. Kingsway Capital, controlled by Manuel Stotz, invested $118.1 million, and Vi Capital acquired shares for $58.3 million. This was partly paid for in US dollars and Toncoin, the native cryptocurrency of the Open Network blockchain. This infusion of capital is significant and ties into their strategy, especially with the advisory services agreement with Kingsway Capital, granting them a multi-million-dollar set, up fee and an annual advisory fee tied to the company S market capitalization. This arrangement with a 20-year term suggests a very close and long-term relationship between the company and Kingsway Capital. The audit committee is responsible for overseeing the company S financial reporting. They reviewed the financial statements for the year ended the 31st of December 2024 with Grassi, the independent auditor. Grassi has also confirmed its independence. This is a routine, but critical function ensuring that the numbers you see are reliable. Let's look closer at executive compensation again, particularly the pay versus performance section and the relationship between pay and performance. The report states there is a decrease in total shareholder return year over year, yet compensation actually paid to executives has increased substantially. In 2024, total shareholder return decreased by 98% compared to 2023, while the CEO's compensation actually paid jumped from $340,000 to $1,502,000. This significant gap is a major red flag. It raises questions about whether the executive compensation structure truly aligns with creating shareholder value. While stock awards are meant to do this, the massive increase in pay despite a near total loss of shareholder value is a classic example of compensation that may not be tied strongly enough to the company's actual market performance. It is like the team got paid a bonus for losing the championship game by a landslide. The employment agreement for Rory J. Katia is quite detailed, outlining severance packages in case of termination without cause or for good reason, which could include monthly payments and accelerated vesting of awards. It is common practice to have these agreements, but the specifics often reveal the company's commitment to retaining key executives. His agreement remained in effect, and he transitioned to CEO of the global digital media division. Notably, he received a large RSU grant in August 2025. The pay versus performance table is stark. It shows that while shareholder value plummeted, the compensation paid to executives saw substantial increases, especially from 2023 to 2024. For instance, the CEO's compensation actually paid more than quadrupled, while the company's net loss, though reduced, remained significant. This disconnect is the most pressing concern for shareholders. It suggests executive rewards are not directly reflecting the overall success or failure of the company in the eyes of the market. So, what is the big picture here? Ton Strategy Company seems to be navigating a complex path. The heavy focus on digital assets and the involvement of investment funds like Kingsway Capital and Vi Capital suggest a strategy heavily reliant on the cryptocurrency and blockchain space. The recent significant capital raise through a private placement partly in Toncoin reinforces this direction. However, the pay for performance disconnect is a major concern. While they are bringing in new leadership and experience and securing capital, the fact that executive compensation increased so dramatically while shareholder returns tanked is a serious issue that needs addressing. It might signal that the company's internal metrics for success are diverging from what the public market values. Now, let us shift to my take on what all of this means. Ton Strategy Company appears to be in a phase of strategic realignment, heavily leaning into the digital asset and blockchain world. The infusion of capital from the private placement is a clear sign of their commitment to this path, and the board composition with individuals from established crypto and financial backgrounds supports this. However, the glaring discrepancy in the pay versus performance metrics is a serious concern. A 98% drop in shareholder return alongside a massive increase in executive pay is not a recipe for shareholder confidence. It suggests a potential miscalibration of incentive structures where executive rewards are not adequately linked to broad market performance. While the rationale behind executive compensation, particularly stock awards, is to align interests, the data here suggests this alignment is not effectively translating into shareholder value. The substantial related transactions and the long-term advisory agreement with Kingsway Capital, controlled by the executive chairman, also warrant close observation for potential conflicts of interest and ensuring arm's-length dealings for the benefit of all shareholders. In conclusion, Ton Strategy Company is making bold moves in the digital asset space, securing significant funding and restructuring its leadership. The company possesses a clear strategic direction. However, the undeniable disconnect between executive compensation and shareholder returns is a significant weakness that needs immediate attention. The opportunity lies in truly demonstrating how executive compensation will be directly tied to creating sustainable shareholder value. My view is that while the company has strategic ambition, the current compensation model raises serious questions about accountability and alignment with the interests of its public investors. Alright, that is our deep dive into Ton Strategy Company's proxy statement. What did you think of this report and especially that pay for performance gap? Let me know in the comments below. If you found this analysis helpful, smash that like button, subscribe for more corporate breakdowns, and don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and I'll see you in the next one.